Before we can even begin to think about managing financial risks, we need to understand what risk actually is. So what do we mean by the word risk? We often think about probability and chance, as well as failure and loss. These terms make sense if you are considering skydiving out of an aeroplane. However, risk, as per the Australian Risk Standard, can be defined as the effect of uncertainty on objectives. That is, risk is any deviation that may occur from what was expected. In the context of financial risk, we are considering whether changes in financial related items impact the ability of the organisation to achieve its objectives. It is important to note from this definition that the deviation from what is expected can either have positive or negative outcomes. In business and in life, we typically consider risk as only focusing on the negative financial impact, and we try to minimise the damage that can be caused. That is, we typically think of financial risk management as a value protection exercise. However, it is important to consider all financial risks and ascertain whether and how financial impacts can arise. Any decisions we make or activities we undertake to create value will attract a certain amount of risk. There are always variables and uncertainty in our business operations. We therefore need to consider financial risk management as being an inherent part of value creation activities. From here, we note that risk is not always a bad thing. To run successful businesses, we don't always need to eliminate risks. However, we do need to identify risks, understand how they may impact our business, and then manage those risks such that we can have the greatest chance of achieving our business objectives. So let's turn our attention to financial risks. There are 7 categories that we use to classify and analyse financial risks. Think about a small company that manufactures windows for houses and has received a large order from a customer. And to fulfil this order, they enter into purchase contracts with suppliers for very large quantities of glass and aluminium. The company has incurred an upfront liability that will actually fall due before the customer receives its order and pays. Therefore, the company has a risk exposure related to having sufficient cash to pay the supplier invoices when they are due. This risk exposure is greater if existing assets cannot be sold quickly for cash without significantly reducing the price received. This is liquidity risk and relates to having enough liquid assets, that is cash, to be able to make any payments that are required on financial commitments when they are due. If we think about what can happen if a company has expansion plans and requires funding from external parties, or where the company has started its expansion already and has some long-term debt in place which is coming up to maturity. In both cases, the company needs to access funding, either through borrowings from lenders, whether new debt or rolling over existing debt, or equity from shareholders. What might the risk be in this case? This happened to Centro Property Group in Australia in 2007 as it became wrapped up in the global financial crisis. Centro had expanded at an incredibly rapid pace and as such was really highly geared. Therefore, when funding from banks and large investors became harder to access, Centro was unable to access additional funding and roll over its long-term debt. The end result was its stock price crashed and a major restructure and asset sales took place. This is funding risk. Will you have access to funding as and when you need it? Consider the situation where a company borrows money from a bank to expand its operations and purchase a new factory. There are risks associated with changes in the interest rate. So if the loan is a variable rate loan, what might you be exposed to? Or if the loan is a fixed rate loan, do you still have a risk exposure? Conversely, consider the situation where a company lends or invests money. These risks associated with variations in interest rates also apply. These are examples of interest rate risk. With floating or variable rates, changes in interest rates can lead to higher or lower interest amounts. Even with fixed rate loans and investments, the fair value of the instrument can actually fluctuate if interest rates change. In a globalised economy, there are greater opportunities to export and import products. But in doing this, you need to consider what can happen when you sell or buy in a currency other than your own functional currency. Fluctuations in foreign exchange rates will affect you differently depending on whether you are importing, that is buying from overseas, or exporting, that is selling overseas. The impact will also differ depending on whether prices are quoted in your functional currency or a foreign currency. A key point to remember is that as soon as the transaction occurs in your functional currency, there are no changes to the amount of your functional currency you receive or pay. However, note that foreign exchange risk can still exist in this situation, as your overseas customers or suppliers now bear the risk of price fluctuations, and this can lead to lower or higher demand, depending on the movement of the respective currencies. Consider an Australian company who exports wool to China in US dollars. In this case, the Australian company benefits if the US dollar strengthens and the Australian dollar weakens. This is because a stronger US dollar will mean more Australian dollars will be received when the transaction takes place. But let's now consider an Australian company who imports homeware products from China with purchases transacted in US dollars. In this case, the Australian company benefits if the US dollar weakens and the Australian dollar strengthens. This is because a weaker US dollar will mean less Australian dollars will be required to pay for the purchase. We've just gone through examples of foreign exchange risk. In particular, these examples demonstrate one of the main types of foreign exchange risk exposure, and that is transaction exposure, which comes about through normal operational activities, such as selling products or making purchases. With foreign exchange risk, there are also two other main categories of exposure. Translation exposure, that is fluctuations in the values of assets or liabilities, such as a net investment in a foreign entity, and also competitive or economic exposure, that is exposure as a result of adopting a different approach to foreign exchange risk compared to your competitors. A key export of Australia is iron ore. In recent years, the demand for this from China has been extremely high because iron ore is a primary component in steelmaking. But this demand is now slowing. Iron ore is a commodity, and therefore companies producing and selling iron ore are susceptible to fluctuations in the price, which is largely driven by supply and demand. A commodity is a raw material, basic good, or primary agricultural product. The key thing is that it is interchangeable with other commodities of the same type and grade. Thinking about iron ore produced by one company will essentially be the same as iron ore produced by any other company. So if the demand for iron ore in China is dropping, what can we expect this to do to iron ore prices? And what effect will this have on our Australian iron ore exporter? If prices drop, so too will sales revenues. But costs to produce will not necessarily drop. This can have a significant impact on profitability. Let's think about this further down the supply chain. If a company in China is importing iron ore for steelmaking and the prices drop, what effect will this have on the Chinese company? When the commodity is used as an input and prices drop, this is beneficial for the company purchasing the commodity, in this case our Chinese steelmaker. These are examples of commodity price risk. In business, we often sell our products or services to customers on credit, meaning that they have a certain amount of time before they have to pay the invoice. Unfortunately, however, there is always a chance that the customer will not make that payment, and we will be left with having incurred the cost to provide the goods or service, but do not receive the revenue from the sale. Or consider the situation where you enter into a contractual arrangement with another company, say to install roofing for a new factory. What if the counterparty, the roofing company, does not uphold its end of the contract? What risk could you be exposed to here? This is known as credit or counterparty risk. When it comes to financial institutions or treasury and similar operations within organisations, there is always a chance of human error or fraud taking place, which can have an effect on the financial outcomes and objectives of the organisation. Consider, for example, an administrative clerk in the treasury function who processes the bank transfers for deal requests and accidentally adds an extra zero to the dollar amount of a transaction. Or consider the situation where the clerk was acting fraudulently and transferred funds into their own bank account for fake deals that had not been authorised. These are examples of operational risk. When dealing with financial risks, it can be helpful to visualise the type of business, the transaction or cause of the risk, and the objective or outcome that the business is trying to achieve. It is only when you have this working understanding that it is possible to implement appropriate risk management strategies.